Hi, looking at 2020 was quite a seminal year for all of us. I think it was a year where suddenly reality hit home. The virus wasn't something in China. It literally came to South Africa in a meaningful way. And suddenly it entered our immediate families and friends through the virus, through the sickness, what's happened in the economy as well. And yes, suddenly it became a reality to us. And as fund managers, we always live in our own reality, but we also experience that lived reality of the virus and what it means in our own families. And yes, we understand what our clients go through. So when we turn to the markets, 2020 was indeed a very good year for the fixed income markets. We had very good returns. Think about the SARB cut rates by 300 basis points. Inflation was around 3.3% and growth was probably around -8%. But what it meant was that from cash alone, you probably had more than a 5% return. From inflationary bonds, probably around a 4% return. And then from nominal bonds, an 8.7% return. It's not many years that we see about 4.5% real returns from nominal bonds. Plus, you had a guarantee basically on the coupons in a market where income was hard to find because property companies and equities withheld their distributions. Going forward, we still think that 2021 will be a very good year for fixed income as well. Why? Because first valuations still remain attractive. Our curve is very steep, meaning that short end rates are anchored, that the SARB will probably not hike rates in 2021, but the market is pricing for a lot of negative news. Yes, bad economic growth, bad government finances, Eskom not delivering on electricity supply. It's in the news. We read it every day. But yes, it also sits in the price. So when we look at our portfolios and our valuations, we think it makes sense for our investors to be invested in longer dated South African fixed income. We still like nominal bonds. We've changed our view on inflation bonds. We do like inflation bonds now. We think it will be good for investors to be invested in some inflation protection. And if we look at the expected returns going forward, we believe there's good returns for our investors. So sitting in cash will not make sense because inflation this year will probably migrate from around the 3.5% up to 4%. And that's where you'll get cash, is around 4%. So sitting on cash, you're not going to have a real return, a net return after inflation. But if we look at something like credit markets, like enhanced yield fund, we could probably have a 1.5% above cash, so let's say around a 5.5% return at a very low risk level. And then our two favorite asset classes would be nominal bonds and inflation bonds. So firstly, nominal bonds, we think, well, we could easily have a 8.5% return from nominal bonds, and from a very similar number from inflation bonds. Why? Because firstly, inflation bonds are very cheap at the moment from a valuation perspective. And secondly, investors will receive the benefit of rising inflation from around 3% to 4%, so what we call that inflation carry. So our best strategy at the moment and recommendation for our clients is to be exposed to various fixed income asset classes this year. Don't make a binary bet on either nominal bonds or inflation bonds. Rather have both in your portfolio. If you really don't know how to choose between the different asset classes, rather go to a multi-asset fixed income fund like our flexible income fund, which actually makes that selection for clients. We think there are good opportunities there. So yes, let's go and hunt for those opportunities in the most interesting asset class in South Africa. Thank you.